Hello everyone. In this video, we will explain the detailed explanation and practical application of the funding rate arbitrage strategy. This video tutorial is only for exploring communication strategies and trading ideas, and does not constitute any investment advice. It only represents the personal opinions. We will explain the ideas and parameters of the strategy, and finally give a practical demonstration of the strategy. We have opened the strategy, and here we have rented the Binance funding rate arbitrage strategy traditional account edition, traditional account version. We can find the strategy in our list of strategies. We click on the strategy name and enter the strategy description and menu. We know that contracts are divided into delivery contracts and perpetual contracts. For example, in the further delivery date of a delivery contract, the greater the price fluctuation of the contract and the greater the deviation from the spot price. However, on the delivery date, the settlement will be based on the spot price, so the price will always return, unlike the scheduled delivery of delivery contracts. Perpetual contracts can be held indefinitely. Therefore, perpetual contracts have an additional funding rate mechanism than delivery contracts to adjust the prices of perpetual contracts and spot in a timely manner. For example, during a period of time, there are more bullish and long position people, which can lead to the price of perpetual contracts being higher than the spot price. As the funding rate is generally positive, at this time, the funding rate will affect the price of perpetual contracts and approach the spot price. At this point, the long position side will pay the holding fee to the short position side on time. That is, the greater the deviation of the perpetual capital cost market, the higher the fee will be, making the price difference tend to regress. This is the funding rate mechanism for perpetual contracts. Our strategy is to hedge futures between spot and futures and perpetual contracts. And the main purpose is not to arbitrage the price difference between contracts and spot price, but to arbitrage the funding rate. Let's take a brief look at the risk analysis and mitigation. There are 4 points. The first one is the negative rates factor, which usually has a minimum rate of -2 points. If it occurs once, it is equivalent to losing 200 times of the 0.01% rate profit, that is, collecting a lot of funding rates, and then losing all at once. Our solution is not only to avoid arbitrage of perpetual contract rates in new currencies or currencies with significant fluctuations, but most importantly, to do diversification hedging. For example, if we hedge more than 30 types of hedge funding rates in sequence, the losses for each currency will only account for a small portion. In addition, if such a situation occurs, it is also possible to close the position in advance. However, due to handling fees and closing position costs, We cannot close the position immediately when encountering negative funding rates. Generally, it is necessary to close the position at a capital rate below minus 0.2%. When the general negative rate is applied, the price of perpetual contracts will also be much lower than the price of spot. And the position will be closed at this time. Negative premium, it can also bring some profits after deducting transaction fees. The second is the change in premium. Generally, a positive rate represents a perpetual contract, and for spot contracts, it is a premium. For example, when a positive rate is applied, the price of a perpetual contract is generally higher than that of spot contracts. If the premium is high, when the premium returns, a certain amount of premium return spread income can be earned. Of course, the strategy has always been held for the long term. As we just mentioned, the purpose of the strategy is not to do price difference regression or arbitrage, but mainly to do funding rate arbitrage. Therefore, generally speaking, strategies are held for the long term, so the strategy will not actively take the advantage of this portion of profits. We need to be careful not to open positions at a high negative premium. For example, if the negative premium is minus 1% now, opening positions at this time for arbitrage will obviously be at a loss. So, in the long run, the issue of premium changes can be basically ignored. We need to pay attention to setting funding rates and arbitrage positions when there is a positive premium. The third one is the risk of contract liquidation. Because we are hedging, taking long positions in spot and short positions in futures. At this time, if we short a certain variety of a contract and the increase is significant, there may be a risk of liquidation. Due to our use of diversified hedging to handle the risk of liquidation, this part of risk will be reduced significantly. For example, using a perpetual contract with a leverage of 5 times, there is a possibility of such a liquidation unless the overall price rises by 20%. In general, the probability of all currencies rising by such a large amount is not particularly high. And since we hedge against spot, even if liquidation appears, at this time there will be no loss, as long as we close our positions and transfer funds, or other, we can increase the margin at any time, allowing the higher the leverage of the contract, the higher the utilization of funds, and the greater the risk of contract liquidation. The most important point is that if the market situation is in a bear market for a long time, the returns of funding rates will be greatly reduced, because funding rate arbitrage mainly does bull market arbitrage. Generally, the bull market arbitrage is when the funding rate is positive. We open short positions on perpetual contracts, long spot, buy spot, and do hedging arbitrage at this time. Therefore, our strategy only involves positive arbitrage and does not involve negative premium reverse arbitrage, which requires our attention. That is to say, this contract will only be short in futures and long in spot rather than long in futures and short in spot. Next, let's take a look at the specific strategy ideas, which include the following 5 points. First, the strategy is designed with the function of filtering currencies automatically and specifying currencies manually, which can allow the strategy to reference historical funding rates automatically. Transactions will only be made when the threshold is exceeded. Second, obtain the current rate exceeding the set threshold automatically. Start placing orders for futures and spot simultaneously, and fix a certain hedging position, that is, a fixed value. Third, if a single currency rises too much, the strategy will close the position automatically. To avoid the high risk of perpetual contract liquidation. Fourth, if the funding rate of this currency is too low, we need to close the position to avoid being charged a rate because we hold short positions. If the funding rate is negative, we will have to pay a funding fee to the bulls. Fifth, as there is no requirement for the speed of opening positions in the strategy, the method of iceberg commission is used for opening and closing positions to reduce the impact on the market position. Overall, the capital rate arbitrage strategy has low risk, large capital capacity, and is relatively stable. The specific profit needs depends on whether the overall market situation is a bull market or a bear market, and whether the funding rate is mostly positive or negative. If the exchange has idle funds, the strategy can be considered suitable for pursuing low-risk arbitrage goods. We have already rented the strategy from our strategy library. Then we run the live trading strategy on the FMZ Quant trading platform. We first need a strategy and then we need a Docker. The Docker is our strategy program carrier, and we also need to configure exchange account information. Firstly, let's deploy the Docker. Here we can use FMZ platform's one-click rental Docker VPS, which rents a server on behalf of the FMZ platform and automatically deploys the Docker. This is relatively simple and convenient. If you are not familiar with Linux operations or commands, you can use the one-click rental Docker VPS. This method will incur additional server charges. We can also use manual deployment, that is, add a Docker manually, which means manually deploying on our own devices. Here we choose the former one-click rental Docker VPS. We click Buy it now and click OK. Enter our platform password, click Authorization. Wait for a moment, the Docker will be deployed successfully. We can see the status is online now, that is, the Docker is deployed successfully. In addition, we need to configure the Exchange account. We can directly configure the Exchange account on the platform page. Here, we click Add Platform. And here we select Binance. Note that our strategy requires adding two exchange objects, Binance Futures and Spot, both of which need to be configured because we need to hedge short futures and long spot. Next, we will fill in the corresponding access key and secret key separately. The access key and secret key are encrypted on the website of the FMZ platform, which means that the FMZ quant trading platform will not record any plaintext key information. The exchange account that we have configured will be displayed when we add the robot. Since we have deployed both the Binance Spot and Binance Futures exchanges, let's go to the bot page. We click Add Bot. And we can name the bot as Test Funding Rate Arbitrage. And we can use the default kline period of 1 hour. We select the strategy we have rented, as well as the Docker we deployed just now. Note that we do not recommend using the public Docker below because it may be updated, restarted, or stopped periodically. Public Dockers are only for beginners to the platform for testing and practice. If we want to run our own live trading strategy, we should still use our own deployed private Dockers. We choose the strategy as the operation strategy, and we will explain the strategy parameters one by one later. Let's first configure the account. First, we add the platform Binance Spot and use the default trading pairs. Click Add button. Then we add Binance Futures. Click Add button. And let's take a look at the strategy parameters. The strategy parameters are on the strategy details page, but the strategy can be run on live trading and does not support backtesting. Therefore, we can only look at the description and use of some parameters. We can refer to the manual for the specific description of the parameters. Let's take a look at the precautions. Firstly, any strategy carries risks, and investment needs to be cautious. If we encounter extreme market conditions or API data errors, it may cause unexpected losses. At present, the strategy only supports Binance perpetual futures, and other exchanges may be added in the future. The initial strategy requires USDT as the initial asset. Futures are perpetual contracts based on USDT, while spot trading mainly involves USDT trading pairs. When we run Binance perpetual account strategy, the strategy will automatically set Binance perpetual account to a one-way position. Full position mode with 10 times leverage. The default strategy is that all transactions exist, that is, all trading pairs that are online in the spot market, and the corresponding perpetual contracts in the perpetual market. The strategy cannot have positions in other currencies. During its initial operation, if we want to add BNB, if we want to use BNB to offset transaction fees, we can include BNB as non-trading currency. In the strategy parameter settings, then we need to add two exchange objects. The first is to add spot exchange objects, and the second is to add future exchange objects, which are the two exchange objects we added in the live trading before. As for servers, we recommend using servers from Tokyo, Japan, rather than domestic servers. If we use domestic servers, Binance cannot be accessed. Both exchange objects can use default trading pairs. Apply for the same API key and configure it as two exchange objects. It is recommended to use a 1-to-3 ratio between futures and spot funds. The less futures funds, the higher the utilization rate of funds, which increases the risk of insufficient margin. If futures margin is insufficient, a certain amount of corresponding spot funds need to be transferred. To avoid insufficient spot funds, we recommend that spot funds be greater than the ratio of holding value multiplied by 30. The strategy adopts IOC synchronous ordering. If there is no transaction, it will be cancelled automatically. So there will be no cancellation operation in the strategy log. The strategy is to use market price orders to place orders and avoid situations where no transactions are made. If there are various timeouts in the strategy, it indicates that there is a timeout situation when the strategy is making network requests. This is a normal situation as long as the timeout is not constantly reported, because the strategy's API interface will be accessed many times, and a few timeouts are normal situations. If it's a single state, not a continuous, it's a single state, not a continuous state. If the strategy keeps reporting timeout, it indicates that the server may have network issues. Due to the minimum order amount limit, the value of the currencies we ultimately hold is not the present value we set, which may result in some deviation. Holding BNB in the spot account can be used as a discount for transaction fees, but it conflicts with the strategy, as the transaction fee consumption of the strategy is not high. We can also avoid using BNB as a deduction for transaction fees. If we need to use BNB for deduction, we can list it as non-trading currency. If our futures account has BNB, it has no impact actually. Currency needs to meet both conditions before hedging, and arbitrage opening refers to the cost of arbitrage funds. To open a hedging position, two conditions must be met. The rate threshold for opening and the premium rate for opening must both be greater than conditions we set in order to proceed with the opening. When closing a position, the position will only be closed if the current rate is lower than the closing rate threshold and the closing premium rate threshold. Alternatively, we can set a premium rate for direct closing. And when this premium rate is reached, we do not look at the funding rate, but only at the premium rate, as long as the premium is negative when the premium rate is reached and triggered. The position will be closed directly. This condition does not depend on the size of funding rate. It is to avoid extreme market conditions and extreme negative premiums, which is also a form of protection. So there are two situations for closing positions. One is triggered by both the closing funding rate and the closing premium rate, and the other is triggered by the mandatory direct closing premium rate. The strategy can be restarted at any time without closing positions or clearing all positions when the strategy is stopped. We need to explain the strategy parameters. The first parameter is leverage, set by the platform, which mainly affects the total opening amount of the account. The default is 10 times, and we can set it lower. This is not the actual leverage of the account, as the opening account is a multi-species position, so the final actual account position is not equal to the leverage we set. But it does not affect the risk. It affects the total opening amount. We mainly look at the leverage risk of an account based on its actual position. The second parameter is the non-trading currencies. We can exclude some non-trading currencies, which we can manually set. For example, if we do not want to trade BNB, we can enter BNB when setting strategy parameters. If we do not want to trade another currency, we can enter a comma in English and then enter the name of another currency, so that we cannot trade the currencies we have set. After the automatic funding rate for opening a position is activated, the currency to be hedged will be automatically determined based on the rate sorting. The currency to be hedged and the perpetual contract will be automatically determined based on the ranking. Of course, it is a currency with a higher funding rate, or a currency with both higher funding rate and premium. in order to extract the funding rate. The quantity of opening currency can be set after activating automatic rates. If we set it to 30, it means that only the currency corresponding to the top 30 highest funding rates will be sorted. Why do we need to use it uniformly for 24 hours? Because different currencies may have different periods for charging funding rates. We convert them uniformly on a 24-hour basis. The next parameter is the opening rate threshold, which is one of the two conditions we just discussed for opening a position. The opening rate threshold is when the 24-hour rate of the current period exceeds this value, and hedging will be carried out. Due to the different charging intervals for different currencies, we convert them on a 24-hour basis. The threshold for closing the position rate when the current rate is lower than this threshold in order to avoid being charged. If the premium is lower than the closing premium rate at the same time, the position closing will begin. Due to handling fees and impact costs, we suggest not setting it too large and instead set it to minus 0.001. The opening premium rate is related to the opening rate, and only open positions when the premium rate exceeds the threshold we set. According to the sorting in status bar, a typical bull market can be set to 0.002, which can reduce the cost of reducing positions. If we want to open the position as soon as possible, we can also lower it a bit. That is to say, when opening a position, there are two influencing factors. One is whether the current rate has triggered the opening rate value we set. Another is whether the current premium rate exceeds the opening premium rate we have set. The calculation method for opening position premium rate is also very simple. Subtract the spot ask from the perpetual contract bid, and then divide it by the spot ask. The reason for this design is due to the fixed perpetual contract and spot price difference, which cannot handle all species, because if the price difference of Ethereum is 10, the price difference of other currencies may be 1. It cannot be processed uniformly. Therefore, we will convert it all into one rate, which is to set a unified premium rate. For example, if we set the premium rate to 0.1% or 0.2%, it is consistent for all currencies. The closing position premium rate is similar to the previous one and is calculated using the same method. If the premium rate is less than the closing position premium rate we set, and the current rate is also lower than the closing position rate threshold, an iceberg commission closing position will be carried out. It is important to note that the difference there should be sufficient space for opening premium rates and closing premium rate to convert handling fees and slippage points. Therefore, when setting this parameter, it is necessary to consider it carefully. Our default is the highest handling fee, which is 0.3%, and of the cost of opening and closing the position, and it can be set as minus 0.005. The direct closing position premium rate is another closing position condition we just mentioned. When this condition is triggered, it does not depend on the size of the funding rate as long as the premium rate exceeds the closing position premium rate. The closing position will no longer consider the size of the funding rate. It is used to handle extreme market conditions. The liquidation or closing position situation can be set to minus 0.01. The opening position value is used to set the market value of a currency that meets the opening position conditions. That is, how many positions and values need to be opened for a single currency. For example, when considering spot funds and operating 40 currencies, if we set the opening value to 200, our spot funds must not be less than 8,000 USDT. Otherwise, if the opening value is too small, it may lead to the inability to place orders, that is, the inability to open positions below the minimum order amount. The value of an iceberg order, also known as the size of an iceberg order, is generally smaller than the opening position value, but it cannot be set too small, otherwise it will result in the inability to transact. It is recommended to set it to be greater than 50. The alert leverage is mainly used to set the leverage threshold. That is, when the actual leverage algorithm is equal to the total position divided by the margin, and the calculated actual leverage value is greater than the alert leverage we set, no more positions will be added. For example, if we set it to 5 and hold a total position of 10,000, an alert will be given when the margin is below 2,000, and the alert leverage should be less than the opening leverage. Automatic position reduction leverage is a risk control measure that directly closes the position when the actual leverage exceeds this value, and then lowers the leverage value to reduce risk. The next parameter is profit adjustment. During the operation of the strategy, operate the account manually. For example, if the strategy makes profits, we want to extract the profit part If we do not synchronize the data with the parameters after extracting it, it will cause errors in the subsequent profit statistics of the strategy. We must tell the strategy how much money we have proposed so that the strategy can continue to synchronize the data to ensure that there are no errors in profit calculation in the data. For example, if we propose 100U but do not inform the strategy will definitely not know why it is missing 100U, which will lead to errors in calculating profit. Therefore, the parameter is mainly used to set how many assets we have extracted and then synchronize them. Setting 100 means proposing 100, and setting minus 100 means recharging 100 to ensure the correctness of the profit curve. When starting, funds can also be allocated automatically. If we select the parameter, the strategy will automatically transfer USDT between futures account and the spot account according to the proportion we set. It is recommended to use our own account for manual transfer, so we need to pay attention to this parameter. Adding a futures trading object and a spot trading object. These two trading objects must be configured with the same Binance account. The next parameter, allocation ratio. If we set this parameter to 3, that it means that the ratio of spot funds to future funds is 3:1, which means that the ratio set when starting automatic allocation of funds is 3:1 for allocation. When the strategy is first launched, automatic USDT transfers are made according to this funding rate. If we check the automatic transfer function, when the futures leverage is greater than the alert leverage, the proportion of spot funds will be automatically transferred to reduce the futures leverage. But we recommend using manual transfer, which is more controllable. If we want to automation, we can check automation. The loop interval is mainly used to control the frequency of strategy requests to the exchange API interface. This frequency should not be set to low, otherwise the requests will be very frequent, which may cause the interface to refuse access. Generally speaking, setting it to 1 second is sufficient, and the entire strategy is looped at 1 second interval before requesting the next one. This depends on our actual application. As long as it is not set too small, such as setting it to 0 seconds, it will definitely not work, and it will cause the exchange to access the interface too frequently, resulting in the interface being denied access. In addition to the parameters mentioned above, there is also a strategy interaction function that allows for manual transfer. In the strategy interaction section, once we have created the strategy, we can see a location where we can manually transfer funds. We enter a fund value here. and then click the transfer button to perform a manual transfer. If we input a positive value, it represents a transfer from spot to futures. If a negative value is entered, it means transferring from futures to spot, and clicking once will take effect. How to close all positions in the strategy? If we have run for a period of time, we can still make a profit. But I don't want to continue running. If we hold a large number of positions, closing them on the exchange one by one manually would be troublesome. We can set the current rate threshold of the strategy to be very high to ensure that it will not open new positions, and then set the premium rate for directly closing positions to be higher, such as 0.001, which will gradually close all current positions after running for a period of time and closing it out gradually. The strategy will no longer have any positions. In this way, close all positions in the strategy. How to improve the utilization of funds? We also have some suggestions, but we still recommend putting risk control in the first place. After all, stable strategies and controllable risks are the first choice, not blindly pursuing high capital utilization rate through strategies. The measurement standard for the risk of futures liquidation is mainly based on the actual leverage used. If it is greater than 8, more attention needs to be paid. When we set a 5 times leverage, the average increase in all holding currencies is more than 20%. At this point, there is a risk of liquidation, although liquidation does not necessarily mean loss. Future losses correspond to spot profits. Although there is hedging, there is also a risk of losses from liquidation. That is to say, when there is a risk of liquidation, it is necessary to pay attention to the account, transfer the margin in a timely manner, or reduce the position in a timely manner. The risk of significant changes in premium during the operation of a strategy, if the premium of a certain currency changes from a positive premium to a negative premium, or if the positive premium continues to rise, the risk of significant changes in premium will bring about losses in the positive arbitrage. However, in the long run, the premium will definitely return and will not last for a long time. Therefore, in the long run, this risk is controllable. The risk of automatic position reduction in strategy, like the automatic position reduction mechanism in Binance, is that when the risk protection fund is unable to take over the position of the wearing user, it will close the position of the counterparty. In other words, the position of the profitable area will be automatically closed, making it easy for position reduction to occur. For example, when the future price drops significantly, the futures are definitely in a profitable state if there are many wearing users at this time. We may be included in the automatic reduction queue. The automatic position reduction queue mechanism allows us to view relevant exchange documents on the process of automatic position reduction. We have also listed the specific calculation process in the strategy of short-selling futures. If there is a significant drop, it will accumulate a lot of profits. For example, if a currency falls by 50%, we will make a profit of 50% by short selling. At this time, there will be a certain risk of position reduction. For position reduction, we have a real-time queue display in the strategy. If the score of this position reduction queue is relatively high, it indicates that the contract is a higher position in the position reduction queue. Although position reduction is automatically processed, we still need to pay attention. After discussing the strategy parameters, we can create a live trading strategy. At this point, we have configured the Docker. Select the strategy and set the parameters. Then we can configure the exchange objects. Click Add Robot. And we can create the strategy. The live trading we created, if opened, will take a long time to trigger. We will directly demonstrate a publicly available live trading strategy that we are running currently. Once the strategy is implemented, it will display an interface that includes our account initial funds, margin, profits, and loss status, spot positions, future positions, and profits statistics, as well as current leverage and position reduction leverage. We have been running this strategy for more than 40 days, and the overall operation is still relatively stable. So thank you for watching. See you next time.